G'day expats and welcome to our first webinar series for the year. My name is Brett Evans. I'm the Managing Director for the Europe, Middle East and Africa region for the Atlas Wealth Management. Joined by my colleagues on the call today. We've got Ben Turner, who's the Managing Director for Atlas Tax, and also Jeremy Harper, who is the Managing Director for Atlas Mortgages. Jeremy is enjoying the delights of Australian broadband right now, so if you can't see him, there's a good reason for that. We're just going to try and tip him in and out on the call just to make sure he can present not using too much bandwidth. So folks, we're just waiting for the stragglers to sort of come in now. This session will go for about an hour, and we'll actually have that live Q&A session at the end, which everyone loves. We're one of the only few firms that actually do that live Q&A. We like to put our necks on the block and give you some opinions and give you that real-time feedback. So I'll give it about another 30 seconds and then we'll run through some housekeeping. We've actually got two sessions of this this webinar, session number 1 today. So for that's during the daytime in Middle East, Europe and Africa, and nighttime in Asia. And then tomorrow, James Ridley, who's the Managing Director for the Australian office, is also working with Ben and Jeremy. So Ben and Jeremy are bouncing on both webinars, which is great. We'll be doing that for the Asia and the Americas region. So let's get some housekeeping out of the way. So no presentation would be replete by a licensed firm without the joys of a disclaimer. So what all that information there pretty much summarises to be: do not take this information as a personal recommendation, treat it as educational or informational purposes only, and if you do need to get personal advice, please speak to a licensed professional. Also, as we're a dual regulated firm, we are required to provide 2 disclaimers. So this is, we're also regulated in Dubai with the Dubai Financial Service Authority. So that's where I am with this team here right now. And this is the disclaimer that represents this office itself. So who is the Atlas Wealth Group? We're the leading provider of Australian expat financial advice, tax, mortgage and asset management services. We've been going since 2011, and we've been, 2013, I should apologise for that. Oh no, 2011, it is 2011. Sorry, I'm having one of those days today. Regulated by many. So we've got ASIC and ATO in Australia, as well as the Dubai Financial Service Authority here in Dubai. We have clients in over 50 countries. We manage over 300 million in assets for Australian expats around the world. And unlike many advisors out there, all of our advisors and specialists are degree qualified in the area that they're specialised in, with numerous postgraduate qualifications and certifications. So what we're going to run through today, I myself will be giving you a quick market update as well as an economic update. Then Ben will be following on, providing a tax update. And then on the mortgage side, Jeremy will be talking about mortgage lending in the property market. And then last of all, we've got the all-important Q&A. So I'll get this show on the road and lead from the front. How do we go in 2024? So this is the ASX 200 market, obviously the share market, and not too bad, up 7.5%. It was a real story of two halves. We had resource sector lagging. We had the bank sectors overperforming, and industrials in the middle sort of supporting that banking sector as well too. So wasn't as strong a year in Australia as we did see in foreign markets, and mainly it was because of that resource sector, and the resource sector is directly linked to obviously China's performance, and we all know what's happening with China right now. They are having a number of economic issues. You know, fiscal and monetary policy is not kicking, and the biggest problem we're seeing right now with China is investor confidence and consumer confidence. They're just not spending money. So for us, the resource sector is an opportunity, but it's also one to be wary of as well too, because it really does ride on the dump truck back instead of the old sheep's back, like we used to call Australia. How do we compare to the rest of the world, or mainly the S&P 500, which is 50% of the world's market? Essentially, you can see there 23% return for the 2024 calendar year by the S&P 500, and versus a 7.5 to 8% return for the ASX 200. Obviously, the big catalyst there, what we call the Mag 7, which I'll go through in a sec, and that's the likes of the NVIDIAs and a lot of the tech companies, which form a very big part of the S&P 500 now. On the Australian dollar side, and this is obviously something that's close to home for a lot of expats, as you can see there, we finished the year on a low, and obviously we started this year even lower again, down to the 61s. It's picked back up again now, but still certainly traipsing those lows. Essentially what is driving this are two things: resource prices and interest rates. So while we have a decreasing rate cycle that Jeremy will talk about through the presentation, that will put further weaker pressure on the Australian dollar, because we have this interest rate differential between what the Central Bank of Australia, the RBA, sets versus the US Fed versus the ECB, and investors are always hunting for yield. So let's say, for example, the RBA decided not to reduce rates and hold them steady against the back of the ECB and the US Fed cutting their rates. In that case, what we would see would be the Australian dollar strengthening, because our yield or our official cash rate will be a lot higher than other countries. At the moment, it's well flagged, and Jeremy run through this shortly, that we are going to see interest rate cuts in Australia in 2025. So as long as that's commensurate with obviously the other central banks cutting their rates, then that weakness may continue. But also too, as I said before, resource and resource prices. Obviously, commodities are a very big part of the GDP of Australia. And if we're selling more, those foreign buyers of those commodities are buying Australian dollars to complete their contracts. Right now, they're not. Those commodity prices are falling. Demand is falling for Australian commodities. And that's why we are seeing the price where we are today. So where we'll be in 2025, at or near here, is probably the best description. High 50s, low 60s, maybe mid 60s if we do see the RBA pause their rate cut cycle against the US Fed increasing their interest rate cycle. But FX markets are very volatile and they can change very, very quickly. So what does 2025 look like for the US market and the economy? We've got a combination of political and economic factors that continue to boost sentiment towards US equities. On the political side, obviously Mr. Trump is now the US president, and he's been very quick at signing in many orders to, deliver on his election promises. On the economic side, that would be I wouldn't say fully employed population base, but a highly employed population base combined with consumer spending, which is still very strong. What last year did was it's actually pushed the US equities market out to 75% of what we call the MSCI World ex-Oz Index. The MSCI World Oz Index is the Morgan Stanley Capital Index. It's like a world index or world exchange. And the US market is now up to 75% of that. So it is a beast. It is something to be reckoned with. And as I'll talk about shortly, the importance of diversification in other markets, not just Australia, but also international markets, is very important. So with that increase in weighting, the US market performance is increasingly concentrated now in a handful of tech stocks. They call them the Mag 7, Apple, Nvidia, Microsoft, Alphabet, Amazon, Meta, and Tesla. So there needs to be, caution thrown in this, because we are seeing a very small group of companies controlling a very high portion of the exposure of the S&P 500 and obviously the MSCI index as well too. So you need to be in there, obviously, because you do run the risk of underperformance against the index, but also to diversification away from those sole Mag 7 companies is very important. We've all seen the likes of Nvidia. You can jump 10% one day, lose 20% the next day. So we need to have other holdings in there, other market exposures, and also to other industries in that portfolio to act like a shock absorber on that. But it does look positive for this year. Certainly if we weren't coming into a falling rate environment and we had a status quo with the president, then the market wouldn't be as bullish. So what does it look like for global markets? Look, it's been an interesting one, because the investors have flocked to the US because obviously that's where the returns have been. The benefit of that is other foreign markets, Europe, UK, Asia, are looking very cheap. The only problem with that is they're cheap for a reason, because investors' funds are going towards the US. If we do see that Mag 7 unwind and the hyper growth that they're experiencing slow down, we may see a reallocation back towards the other developed markets, like said Europe, UK, Asia. But to me, it's going to be we can't time these things. So as I say there, we're talking about valuations creating opportunities for bottom-up stock pickers if you do want to go and look at individual companies, but also looking at the index across the board. If you are playing a long game, it might be a good opportunity for you to be able to average down, dollar cost average down, and build out that side of it as well too. So global equities bottom line, moderating inflation, which is good. Low interest rates, that's also good. And robust underlying growth in major developed markets. They've all contributed to a favourable outlook for this year. Looking out on the global GDP growth side, it remains healthy. Not amazing, but not terrible. Just, where we want to see, above that neutral sort of line when it comes to inflation. Global consumers are in good shape. Everyone's employed that they need to be employed. Incomes are rising. Australia has been suffering that income inflation fall for many, many years, and that's now starting to pick up, but there's a chance it might overshoot. We're just going to watch that one closely. But obviously, the biggest thing we're talking about right now is Trump, who was inaugurated on Monday. What's going to have the effect on the tariffs that he's looking at bringing through? Like we saw the last time he was elected, when he talked about tariffs, people said when the tariffs came on the Chinese products, it's going to be the death of Apple. 12 months later, Apple shares were up 19%. We might see the same sort of occurrence here. He talks about a big game in the election. Whether it comes through as heavy as he is, time will tell. But even if there are tariffs implemented, we won't be likely feeling that sort of effect until 2026. And I thought these charts here to finish up my section just give a nice little synopsis of the visual reputation of where we are. Yes, the markets are high. That's a common question we get asked by all clients. Are we going to have a crash? What we're seeing here right now is corporate profits as a percentage of GDP are high, which is good. The canary in the coal mine is always when we see those fall, and those grey lines there are recessions that the market's gone through in back to 1940s. So as you can see there, the precursor to a recession is always a fall in corporate profits as a percentage of GDP. And we're not experiencing that right now. It's not to say we might go through 1 in 2, 3, 4, 5 years time, but at the moment we're looking okay. Also on a valuation basis, the market is about neutral when it comes to how expensive it is. So there's no expensive premium, and the way the premium is calculated is looking at the share price versus their earnings. So some sectors are overvalued, some sectors are undervalued, but when you look across on the MSCI World Index in terms of looking globally, the market is on average okay. It's not to say you can take the hands off the wheel and relax. Averages are dangerous. As we know, you can put your feet in the oven and your head in the freezer, and on average your body's a good temperature. So a good example of that would be looking at, say, Asia or China on the cheap side, US on the expensive side. Average of the two out, they're okay. So you just need to be careful of where your exposure is and making sure that you are blended across many markets to find that good average exposure, because it is very hard to time these things. When we do see these sectoral or thematic changes, they do occur very, very quickly. So folks, enough of me talking. I'm going to hand you over to the guru on tax, Mr. Ben Turner.
Thanks, Brett. Much appreciated. It's not going to be a huge amount from me today. Brett, are you able to advance the slides for me? Excellent. So from 1st of January this year, we had a change to the foreign resident capital gains withholding regime. So for those that are unfamiliar with that or need a bit of a refresher, this is a regime that was brought in a number of years ago to effectively have any foreign resident who sells a property in Australia, they have to have a certain amount put aside in safekeeping for the tax that might be due on that capital gain. They're trying to stop people who are skipping the country and never completing a tax return and paying their due tax. So this amount has steadily increased over time, but from 1st of January this year, the amount that needs to be withheld is 15% of the sales price, and that's gone up from 12.5% last year. And another big aspect of that, there used to be a de minimis applied. So this would only apply to properties of a value of 750,000 sales price, but now this happens to all properties. So it's quite a significant change. So just to recap, I guess, some of the key features from this, the timing for as far as the date is not settlement date, it's the signing of the contract that triggers the capital gain. If you are a tax resident, this doesn't apply to you. So if you've returned, even if you're non-resident in prior years, if you can satisfy the ATO that you are resident, then you can complete a clearance certificate and ignore this process. And finally, if you are a non-resident and you've worked out that your actual tax is going to be lower than the 15% that they're asking you to withhold, you can apply for a variation. But to do that, you do need to be organised. You do need to have all your tax returns up to date. You need to convince them that your predicted tax for this tax year that you're requesting can be somewhat accurately estimated, and show them the amount. So you need to do the calculation, and then normally it takes the ATO up to 28 days for them to approve that process. So as part of the requirements, they always ask for the contract of sale. So you've got a 30-day settlement and a 28-day ATO service period. It cuts it pretty fine if you're not moving pretty quickly. Now the ATOs, I find, is normally operating a bit quicker than that, but you want to consider that if you actually want to do a variation, that maybe you have a longer service settlement period than 30 days, or you get onto it straight away. All right, next slide. Thanks, Brett. And we've seen the much talked about help indexation adjustments come through now. So this was a change that is applicable to anyone who had a help debt that was in the 2020 on foot at 1st of June 2023 and 1st of June 2024. So what they've done is they've used to assess the indexation at 1st of June every year based on just the CPI figures. CPI figures have been a bit out of step with wage growth in recent years, so they've adjusted the indexation for the 2023 and 2024 years down from that high 7.1% in 2023 and 4.7% in 2024 down to the lower of those two amounts, which was 3.2% in 2023 and 4% in 2024. Now, going forward, it's not going to be a problem anymore. They're always just going to use the lower of those two figures. But what that means as far as people who have a help debt at those particular dates is a few things. The adjustment automatically has been updated in the ATO system. So if you log on to MyGov, you'll be able to see your updated balance. You don't need to do anything in relation to it. If you had paid off your help debt already in the last couple of years, then they give you a credit. Now, the first thing that happens with that credit is that the ATO system looks for any outstanding debts that are with the ATO. That could be in several different areas, but normally activity statements or tax return debts that haven't been settled. And if there's anything left over, they'll refund that to you. To do that, though, they do need to have your bank details on file. So if you've been lodging as non-resident for a number of years and haven't been completing your bank details, then they may struggle to get that through to you. So you don't want to check in that instance. So it's good to make sure you're updating with MyGov your bank details on the file. Unfortunately, there's no changes on the residency rules. It's a bit of a sort of holding pattern at the moment. So as a quick recap on that, there was an original Board of Taxation announcement, and there was some suggestions made to change the residency rules. Both sides of Parliament are quite keen to see some changes to give some certainty around making a residency determination a little bit easier for people. There was a change of government, and then the new government put questions to the general public and the industry, and there was a lot of submissions put forward, but that all happened in September 2023. Since then, we've heard nothing, and that's almost 18 months now, and we're looking at, I think, April or May election that's coming up. So really, what happens after that date really does depend on who gets in at that point in time and what's on their radar. But I'm hearing a lot of talk about cost of living pressures and affordable housing, but not much in the way of residency. It hasn't been in any budget announcements for the last 3 years. So I do think this is a lower priority item for the government. So I do think the key message is that it's business as usual. I do get a lot of people who seem to think the 45-day rule that was proposed in the Board of Taxation report is somewhat law. It isn't. You need to be aware that you can be a resident if you're in Australia for less than 45 days, but often in many cases you could be in Australia for longer than that and still and be a non-resident. It really does depend on a range of factors, but if unsure, please speak to us and we'll clarify for you. I think that might be all from me, Brett. There was a few items that President Trump came out with in his inauguration yesterday, which there is still a lot of question marks around that. Some of it was talking about tax potentially being doubled for expats under certain conditions if there is that penalty. If the big, I think tech companies are sort of seen to be treated unfavourably, then it could be bring down the hammer on that. But it's a lot of questions around that, around whether that's something he can achieve through the legal powers that he's got or not. So a bit of a wait and see on that, but we'll be sort of seeing how that goes.
No, look, definitely, man. I think even Gina Reinhart was heading over to the US with the checkbook, wasn't she? So he's trying to create the capital flows, that's for sure. And it's going to be interesting to watch over the next 3 to 6 months to see what rubber hits the road. Just before we jump in with Jeremy, just the folks out there reminding, there is a box down the bottom that says Q&A. So as we're talking, if you're thinking of questions that you want to ask, click in the box, put in your question, and then at the end of the session, we'll run through those and give you guys some live answers. So I'll hand it over to Jeremy now, and he can run through his section.
Great. Well, thanks, Brett. Thanks, Ben, and thanks everyone for tuning in. I'm going to turn off my camera because I've got dealing with some dodgy internet. Thanks to Sydney, the closer we get to the CBD, the worse it is. So fantastic little selling point. So we're just going to give you a little bit of a mortgage and lending update on 2024, and maybe what are some of the trends we'll see head into 2025 on the mortgage and the property front. So this is probably front of everyone's breakfast table is the cash rate, 4.35%. If we look at 2024, the market and households were anticipating that cut to come through November, didn't eventuate. And I think we saw that in some of the property market leading into December. Myself, typically we see, the market sees a real rush in terms of people buying, settling before Christmas. That certainly wasn't the case. It sort of bubbled along the last couple of weeks of December. But what that's done is, because it's turned into a buyer's market, people are still buying early January. So it has, with the rates higher for longer, it's turned into a buyer's market, and people are being a little bit picky in terms of the stock available, and that's sort of followed through in terms of the buying activity. So we're starting to see a bit more activity earlier, whereas traditionally people aren't really buying property until at least Australia Day, when everyone starts to get back from holidays. So this is, as I was saying, this is sort of where the market was in 2024. People were hanging out for that cash rate, and that's really what I think a lot of people will have the eye on heading to 2025. So if we just go over to the next slide, thanks, Brett. So if we look at the 12-month change in terms of property prices, so as a whole, property grew by 4.9%. So as Brett touched on earlier, that underperformed versus the stock market. But if you drill down into some of those capital cities, you can see there's a bit of a differentiation in the stories. So, Perth, Adelaide and Brisbane all experienced double-digit gains for the year, so outperforming the share market. But Melbourne went backwards by 3%, and Sydney had a slow growth throughout the year. And so I think a lot of the Melbourne-Sydney story is talking particularly around the increase in stock availability. The REA Group reported that just recently in a market update, they had a 7.9% increase in listings in 2024. So supporting that idea that this is turning into a bit of a buyer's market. But on the flip side, you're still seeing tight supply issues, particularly in Perth, and that's reflected in that double-digit growth that they experienced throughout 2024. And if we go across to the next slide, you can see here in terms of what the market is anticipating for 2025. So we've got the first RBA meeting in February the 17th, so just a couple of weeks from now. And if you look at the RBA rate tracker, as of the 20th of January, the market is anticipating a 73% chance of a cut in the February meeting. In fact, if you look at the live update, you can go onto the ASX website. If you look at the update as of yesterday, that actually jumped up to a 78% chance of a cut for the February meeting. So that's what the market's anticipating. And if you look at the future yield curve throughout what they imply for the rest of this year, there's still an expectation of 2 to 3 cuts throughout the back end of 2025. But obviously this is just an estimate of the market. It was wrong last year and it's constantly changing. So, but something to keep our eye on. And what the RBA will be looking at is the December CPI that's going to be out next week for the quarterly December print. So that will be very important in terms of their February decision. And so across the page, if we go to the next page, yes. So the story I saw throughout for 2025 is any rate cuts, particularly in that Melbourne and Sydney market, and now the Brisbane market, as Brisbane's meeting has now overtaken Melbourne, is any rate cut that comes through to borrowers will actually increase their borrowing capacity as where the assessment rates sit. So we're now starting to see fixed rates over the 2 and 3 year pricing is lower than variable, which hasn't been the case for a couple of years now. And so that's also allowing people to, one, take on a little bit of a lower interest rate today, so giving borrowers a little bit more relief, but also it's actually increasing some of their borrowing capacity. So where people are seeing in terms of assessment rates in the market regarding expats or Australians back in Australia, because we're above that floor rate, the way the banks assess your borrowing capacity, if the RBA even cuts by 25 points, that will increase everyone's borrowing capacity across the board regarding if you're proposing for new debt or you've got existing debt. So some of those more expensive markets like Sydney, I think you're starting to see borrowers really sort of hit their borrowing capacity, and that's having a weighting on some of the growth in the property prices. So if we jump across the page, what are some of the trends that I'm seeing now and I think for 2025? So I'm seeing a really big appetite early in this year for expats to, particularly not necessarily for pure investment properties, but looking for that future family home. A lot of inquiry coming out of the US in January, and I'm not sure if that's just because of the change of government or the back of the fires or the strong US dollar, but that's also, I'm seeing strong inquiry coming out of the Middle East, and I think a portion of that is just, as Brett was saying earlier, the strong US dollar. People are now, particularly overseas, are comfortable that maybe locally they're over the inflation dragon. They're on top of their living expenses, and now they've got that borrowing capacity coupled with that stronger US dollar, which a lot of these currencies are pegged to. So now they're what they can actually buy in Australia is going a bit further. So I'm going to see, I anticipate with a weaker Aussie dollar for that trend to continue, and whilst also reviewing any position they've got in Australia versus do they need to access some equity to buy property overseas as well. So I'm seeing people with the high interest rates as well reviewing that, coming off the fixed rates and saying, okay, do we need to pay down some of our Australian debt or even sell down some of our Australian property because we've got some debt overseas. So it's a bit of I'm seeing that on both sides. So if you go to the next page, Brett, and some other trends, although construction costs are still extremely high in Australia, I'm seeing huge demand for expats and locals, but particularly expats as well, looking to improve their existing property. So that could be, putting a duplex, doing a renovation, even that small sort of $100,000, $200,000 renovation. That's particularly popular because it's quite easy to see that that's going to increase their rental yield, particularly in the markets down south where rental yields can be a little bit softer, and just a better utilization of their asset that they've got, that land that they may have already. So just trying to get a better yield overall with their investment, and also unfortunately seeing more marital breakdowns with expats and the need to consolidate debt that they may have in Australia or abroad. So that's a trend that I'm seeing as well. And then finally, just talking about that leveraging with the strong USD, working with clients around that offset facility. So, putting some of that cash they've got perhaps overseas, taking advantage of a weak Aussie dollar, putting those funds in the offset account, reducing their Australian interest rate or interest charged on their Australian debt, and then having that, but still having that flexibility to access if they need to in the future. And then over to the next slide. So in terms of property trends, I think we just probably need to be a bit mindful around Perth is obviously been growing at quite a rate, 19% throughout 2024. I would just keep an eye out because a lot of that's on the back of a strong mining sector. So just be mindful around that if it gets a bit toppy. Brisbane and Adelaide, 11 and 13% was their growth last year. I think that's going to continue. But as interest rates cut, I think you'll start to see a bit more performance out of Melbourne and Sydney. My take is Melbourne will eventually come around in terms of that property clock, in terms of it seems to be on the nose with local taxes and around the tenancy laws, but that will start to have a sort of a counter action eventually. And then across to the next page, thanks Brett. And then finally, in terms of rental growth, we've started to see a bit of a, I guess, call it normalization around the growth. So 4.8% was the national rental index growth for 2024, which was a reduction of 8.1% in 23 and 9.5% in 22. I think that will continue that trend. But if we do see these interest rate cuts in 2025, the net impact compared to those prior years will be similar because obviously the landlord's interest expense will reduce if they've got debt on that property, which will offset some of that weaker rental growth, particularly in some of those southern markets. And that is everything on my end. So thank you, Brett.
Fantastic. Well, thanks, gents. Let's start to repay these good folks and their kindness of their patience by answering some of their questions. And Mr. Turner, the first one will be directed to you by Anonymous. What is a foreign resident? Obviously, we're referring to the FRGW. Non-Australian passport holder, PR visa holder, Australian passport holder, currently non-resident, or all of the above?
So I think the question is probably coming in light of some of the other tests that exist regarding stamp duties and foreign resident surcharges on land tax and things like that, where it really looks at the visas and what your presence is. But for the purposes of the foreign resident capital gains withholding, that's tethered precisely to tax residency. So a tax resident is someone that meets any of the 4 tests. A non-resident needs to meet none of the tests. So if you're unsure if you're a non-resident for tax purposes and you think there's some conjecture on that, you're welcome to reach out. There is a lot of information available on the ATO website as a starting point, but the key thing is to understand it's a tax resident.
Yep, no, totally agree, mate, and well answered. So I think the next question might be for yourself, Ben, or Jeremy, jump into if you have the answer. Has there been any changes to stamp duty? I noticed an increase of 100% of stamp duty charged on my life insurance renewal last year. So not sure with life insurance, is that state mandated stamp duty or is that federal?
Yes, the stamp duties are all state-based.
Yeah,
And look, they have the ability to levy stamp duty on whatever they see fit within their remit. So we don't have the ability to sort of keep tabs on everything, but we do keep a look at property stamp duty, and we have seen certain states where, like Victoria, where they've drastically reduced the threshold for land tax, for example, in each state. So look, I'm not sure if, Jeremy, you're seeing much in the way of stamp duty changes and that sort of thing.
Well, I mean, we saw it in the foreigner surcharge, which is slightly different, which is still a different type of stamp duty. I mean, on a property type, it's obviously levered to the purchase price, so that's obviously increased overall with, so like say, take Queensland for example. I know Victoria's increased their rate that they charge as a percentage of the property price, but nothing in terms of that sort of 100% increase. No, not
Okay. Yeah,
no,
that's
nothing,
strange.
nothing recently.
Okay. Yeah, no, look, I mean, I think I'd actually recommend Andrew just probably maybe reach out to us. You can hit us up at atlaswealth.com/contact, and yeah, we might be able to, I don't know, provide some veracity around behind that, because yeah, when the question came through, I've never seen a 100% increase in stamp duty before, so there might be something in there pertaining purely to insurance products. I'm not sure, so probably warrants some further investigation. Next question is directed towards me. So from Stuart, your expectation is moderating inflation, but with sovereign debt versus GDP greater than 125% in the US, increased money printing in to fund deficits and interest. Will this result in potential increase in inflation? Very good question, Stuart. And I refer back to that chart I showed when the corporate profits as a percentage of GDP are very strong. It does act as a buffer to obviously the US printing more money. Obviously, at the end of the day, no one likes to see governments printing money. It doesn't do a positive scenario for us. But for us, as long as we're seeing that economic growth on that side countering, then at the moment it's okay. But like we saw back in previous years, when we did see that fall off and drop in corporate profits as a percentage of GDP, the money's not there. That's when you start to get, what keeps me awake at night is actually not inflation, but stagflation. When you had scenarios like what happens in Japan, sorry, not Japan, Latin American countries, where you have this rampant inflation going through the roof, but you don't actually have any economic growth. So to me, it's like a speedboat with a wake behind it. As long as the boat's moving forward, the wake doesn't catch up. And then we'll see what Trump has in store for dealing with Treasury and dealing with the spending issues of government. I know he has put through a lot. I haven't actually read them all, but a lot of executive orders, and some of them are actually addressed at spending. Obviously, Elon Musk is in there as the efficiency officer, so he's going to go through and try and clean up that. There's always that bloating exercise that happens with governments at times when the spending blows out. They don't actually look at, there's two people signing one signature with one pen. So you do get that headcount increase over time. So I think what Trump's trying to do is address that issues with these efficiencies, and then hopefully that will bring down the government spending, which is a big catalyst. Next question here from Greg Allgood. I'm living in the UK and have just signed a 30-day contract to sell a property of mine in Australia. The settlement date is the 21st of Feb 2025. Do I have still time to apply for a variation on CGT as mentioned in the presentation? Mr. Turner.
I would say yes. It's prefaced by a few things. You need to get your tax returns, make sure that they're lodged. So if they're lodged for 2024, then you're in a good spot. If you've got a whole bunch of tax returns that are outstanding, then you might struggle. But normally we can turn around those calculations and variations pretty quickly within a day or two. If all the information is available to us, you need to do the CGT calculation and then also work out other things like maybe you're going to contribute to super and those sorts of things. So it's a bit of work to it, but we've got some good contacts within the tax office and they've been very good at being able to expedite if things are getting tight towards that. I don't want to encourage everyone to get lax with it because there is still that urgency and we can't always guarantee the ATO will be so responsive to us, but so far we have had success in instances like yours.
No, thanks, Ben. And for those folks out there who do need to have a chat to Ben and his team, you can get us through atlaswealth.com/contact. Or just go to Atlas Wealth and look for the .com and look for the contact button on the top right hand of the screen. Another question from Stuart here. Withholding tax on property for non-tax residents applies to real property only or other types of property?
Yeah, that's real property only.
Okay, yep. So obviously, just to explain to folks out there, we have different categories of property, and you obviously have non-taxable Australian property. Those are digital assets like shares, managed funds, and ETFs. And then you have taxable Australian real property, physical assets like a block of land, a house, an apartment, that sort of stuff.
It all happens through the conveyancing process, so that's where it'll come up for you.
Fantastic. Another question here from Stuart. Has citizenship-based taxation been discussed by the government? And before, Ben, you answer that, in brackets, they say similar to the US, I'll just sort of provide folks out there what the difference is. So there's two types of taxation in the world. There's citizenship-based and residency-based. Now, the only two countries in the world that do citizenship-based is Eritrea and the United States. So, Ben, I'll hand it over to you, mate, just to provide a bit more detail.
Yeah, well, look, there's been nothing that I've seen that we're ever considering going to that basis of taxation. Like Brett said, it's very uncommon. Really, the US is the only major power that's got taxation based on that. And I don't think there's any appetite for us to go down that path.
Fun fact for everyone out there, the reason why the US brought in citizenship-based taxation was people absconding from the war in the United States back in the 1800s. So that's how they were penalising. So there you go. Something for the files that no one needs. Question from Peter. G'day, Peter, down in Abu Dhabi. How are Aussie banks treating expats with more frequent requests for info? Brackets were up to 3 times a year now. Are there any expat-friendly banks, or should we start looking at global financial providers? Peter, I'm sitting at the coalface of this right now for a lot of clients. The answer is everyone's getting it. Domestic, international. In some ways, the international stuff is even worse because they're quite punitive how they're treating clients. Whereas at least in Australia, you have the protections of AFCA, you have the protections of APRA, all the acronyms down there, who we're seeing when you raise an issue, they're quite conciliatory. Clients with bank accounts overseas, they're just getting accounts frozen and even closed out without even further consultation. The banks will just take a view and say, nope, done, you're gone. I wouldn't jump from the frying pan to the fire. It is the new world we're living in at the moment. You know, AML and CTF, that's anti-money laundering and counter-terrorism financing. We have these laws called KYC, Know Your Client. And there's another acronym I'll throw in here as well called the Common Reporting Standard, which is a global initiative, 150 countries and territories, all sharing data on each other's respective citizens and residents. So the only major country that Australia doesn't have a signatory with is the United States, but that's part of the FATCA agreement, which is something completely separate. So now that the world's becoming very small on the digital side, the banks need key information to be able to work out whether they have to pass your information onto the ATO that then has to be passed on to foreign countries, and vice versa. I'm here in the United Arab Emirates. My data with my bank is shared with the Central Bank of the UAE, which is then passed on to the ATO. So what they're doing is there's gaps quite often that the banks have when it comes to their key information. They need to work out whether they need to share data or not, and that's what these questions are. Also, too, there's a refresh that has to be done. So I'm sorry to say, Peter, but this is just going to be the new norm. There's a lot of folks out there who sometimes get these emails and just ignore them. Please don't. The amount of clients of ours who've had accounts frozen, and it's a real pain to try and get unlocked, is increasing dramatically. So it is the new norm. Do we agree with it? Nope. Can we change it? Nope. And you're just going to have to roll with the punches, I'm afraid, there. Okay, so on to the next question here from Katrina. Are you saying that you expect rates to decrease in February? Let's do across the panel, and I'll go, then Ben goes, then Jeremy goes. No, I don't think rates will decrease in February. I think the labour market's still too strong, and I think one thing Michelle Beluca keeps saying is they're a data-driven decision makers, and I don't think the data is just there yet. Some big ones, yes, but not across the board. So I think they've got 3 green lights and two ambers. So I don't think they're there yet. Ben, what do you reckon?
Look, I'm probably not qualified to give that, but I think it probably depends on whether Albanese can convince the RBA to give an election sweetener by reducing rates in time for some positive news. But I think that's probably unlikely.
Actually, the one thing that the RBA is always very fervent about talking is not trying to influence the election from one party or the other. So, yeah, very interesting.
On there, that was it, yeah.
Yep. Jeremy, what do you think, mate?
Yeah, I think if in doubt, they'll do nothing. So you've got the next meeting end of March. It's not too long after the Fed meeting. As you said, data-driven, so the December readout, which is next week, I think is going to be super important to show where the CPI is. I know employment looks strong, but if you dig a bit deeper, it's just driven by government spending,
Yep.
government jobs. There's so much of the economy in Australia is propped up by government spending, and if any of that's taken away, if you look at like the NDIS, it's just a runaway sprinkler of money into the economy. If any of that starts to wind back, then that will start to come through in the data. But yeah, I think they will sit on their hands for a bit. As Ben said, Albanese desperately wants one before this election. So, but she's been pretty resolute on needing to see the data coming through, and the federal government's not really listening to what she's saying. So yeah, so I think she'll sit on her hands.
Exactly. No, good answer. Question for you, Jeremy, from Stuart. Property trend growth sustainable given high price to income ratio in Australia? Is it unsustainable? I mean, when you're people are coming to you, both residents and expats looking for a loan, have you seen a change? Are people moderating their price levels? Before they're looking at $1 million, now they're looking at 750. What does that look like?
I think this goes a little bit back to the earlier question, where we are in a real two-speed economy in Australia, and it's starting to really separate. So there's people I work with who are looking to buy into Sydney, and they've got 30-40% deposit, and that could be from family wealth or they've generated that themselves. So interest rates are not impacting their sort of buying decision too much. And then you've got people who are trying to maximize themselves. But if you think about it, you really can only go to sort of like a 5-6 times your pre-tax income. And then you start to tap out, not necessarily on the DTI, because banks can go a little bit higher, but with where rates are at. So if an owner-occupied mortgage is, say, 6%, there's a 3% buffer with the main banks. So we have to qualify at 9%, which is basically like a personal loan. So we're trying to qualify for a mortgage at, it used to be personal loan rates. So it's very hard to actually qualify on that monthly surplus with the monthly general living expenses factored in. So if people are trying to borrow a high LVR in terms of the property price, yes, they are hitting that cap, but then there's a big portion of the market that are not as impacted by the interest rates.
Mate, good answer. And just while we're going through these, guys, I've put up on the screen there too the links to our socials there as well too. So make sure you do follow us along, because we do pump out a lot of information on a daily basis through each of those channels, and we find it's a very effective tool in educating and updating expats around the world. Next question is from Anonymous. Looks like it's directed to myself. Is buying US stocks through a UAE-based broker as a UAE resident better, or buying through an Australian brokerage like CommSec better, especially in relation to NRA deductions for received dividends on US stocks? So there's a couple of things here to unpack for Anonymous. Number one is there's two ways, obviously, you can buy US stocks, internationally and domestically. Internationally, most platforms are rebadged US domicile platforms. Now, for most folks, they wouldn't care about that. US is US. Where it does get interesting is when you buy US domiciled assets through a US domiciled account, you do expose yourself to US estate planning tax, even if you've never been in the country in your life. And if that balance is greater than US $60,000 and you pass away, then your estate loses up to 40% of that balance. So we're never a fan of buying US assets through a US domiciled account, or US domiciled assets in a US domiciled account. There is a very much a grey space on buying what we call the UCITS, which are foreign domiciled ETFs in, say, a US domiciled account, like in Interactive Brokers. We have seen mixed cases. We have seen some cases where it wasn't an issue for clients, other cases where Interactive Brokers were adamant that it's a US CITES account, and therefore it's referred straight across to the IRS. So because there's that uncertainty, and the uncertainty pertains to a 40% tax penalty, we're not a fan of doing that. Also, too, there is a 30% NRA, that's a non-resident alien withholding tax, that gets deducted from dividends. Whereas if you do it through Australia, and you do it through certain Australian accounts that are Australian domiciled, then you can essentially avoid the US estate planning tax. And by doing that, obviously you don't run the risk of losing your family 40% of your balance should you pass away. but also too, there's a DTA between Australia and the United States, which reduces the withholding tax rate down using a W8 bend form. Using ComSec, you can't do it because that's it's like going from the frying pan to the fire, because US ComSec doesn't allow non-resident accounts. They do on a very, very, very minor exception basis, but certainly not for UAE-based clients. London and Hong Kong was the last two I saw, but I think they're cracking down on it again now. A lot of folks try to run the gauntlet and get past compliance by putting an Australian address on that account. The problem with that is now they think you're an Australian resident, and therefore they're not withholding non-resident withholding tax. So the 15% that has to get deducted, or 30% if you're in a country that doesn't have a DTA. So I guess, anonymous, that's a very long-winded answer, sorry about that, but there's so many different things to consider when doing that, which might not seem like a big deal, but it's those sort of snowballs that can build up to be a greater problem down the track. So hopefully I gave you an answer. So yes, it is better to buy US stuff through an Australian account, but you need to make sure it's a non-resident account in Australia that you're buying through. Question for Jeremy. Interest-only loans, still easy to get for expat investors or too hard basket? Wife is employed and he is self-employed.
Yeah, interest-only loans are still available. That's fine. You'll pay a premium. So banks will charge a premium of 20, 30 points depending on the lender. So you probably just need to look at your monthly repayment between IO and P&I and see if it's worth it. It'll also reduce how many lenders are available, because not all lenders will do interest only for expats. And then probably more importantly on that last piece about being self-employed, that will reduce your pool of lenders we can work with. So like your majors won't really look at self-employed. So we'd have to, typically working with like a mortgage manager to get that done. So you'd need to verify that using sort of business and personal tax returns, which can be a challenge depending on where where you're based, in which country, and what your filing requirements are locally to verify that income.
Okay, fantastic. That's good to hear. Another question for Ben, actually. Does owning a property overseas help in the case of proving being a non-resident for tax purposes?
Short answer is yes. It doesn't hurt. It actually would help, but it's not. It'd be one piece of a bigger puzzle. So we need to look at it more broadly. But I wouldn't go out and just buy a property in another country just to necessarily firm up a residence position. There's other things that are probably easier to do that are less costly. But if it's part of an overall, plan that works for you, then it makes a lot of sense to do so.
Okay, great answer, mate. Question from Mark. Jeremy, how soon would you see a rate cut translate to pressure on property prices?
Good question. So I think it depends on the market you're looking at. So if you think about, say, that typical first home buyer market these days, like would be sort of 600 to sort of 850. That's sort of where first home buyers sit. They're really under pressure. They're stretched. So you can get quite a few government incentives to go up to that sort of 800-900 to help you get in. So if you're seeing, say, a 50-point cut to that type of market and you've bought something for, say, 700, that type of market will get pushed up, because all of a sudden those first-home buyers that were capped out at, say, 650 borrowing capacity can now borrow 750, and they're going to be your competition on that type of property. So I think probably that 6 to 8, 900 property mark will start to feel a bit of price pressure, as you're saying, if there's a couple of cuts that come through pretty quickly, I'd think. Because if you, just to tie a bow on that, because if the repayments are coming down because the interest rates have come down, it starts to look a lot more attractive in terms of what, if they're renting, if that first-time buyer is currently renting and they want to buy their first property, those numbers start to make a lot more sense for them.
Okay, no, it's good to know, man. And it's a funny one where equity markets react, interest second, whereas property, it is sometimes a slow burn, isn't it, for that filter effect to come through. And what about, there's been debated over the last couple of years with the impending rate cuts. How long with a rate rise or rate cut does it actually filter through for an existing mortgage borrower? Is it about 2 or 3 months after? So the RBA makes a decision this month, the banks update it next month, and then it comes out in their statements the month after. Is that the right way?
It's pretty quick. So I mean, normally it was well, it used to be the first Tuesday of the month was every meeting, and then they would update the banks would update the system sort of 2 weeks later, so end of that month, and then you'd have that letter go out to you, and your monthly repayment would be adjusted for the following month. So it's pretty quick. So sort of 7 weeks after, you'll see that difference.
Very good. Question from Matt. G'day, Matt. With Trump deporting illegal immigrants, how do you think this might affect US unemployment, inflation and local economies and follow-on effects in the New York Stock Exchange? Look, I don't think there'll be much of effect on the markets, because it'd be a very game and risky company to be listed and hiring illegal immigrants. Not saying they don't, but it's certainly running the gauntlet. Look, I think we'll have an issue on productivity in the United States, because the US economy is built around illegal immigrants in terms of cheaper labour and all those sort of services, and whether it's, sort of blue collar sort of work or what that might look like. So there might be, I guess it'd be hard to say. I mean, the numbers, it'd have to be pretty significant to inflect inflation in terms of, say, increasing the price of building a house, for example, or repairs or maintenance and that sort of stuff. But it certainly will have effect. But once again, coming back to my response earlier about averages, there'll be some states in the United States that have very little, legal immigrants, and there'll be some states that have a lot. So I guess in the states that have a lot, it'll be hard felt. Even just things like consumption, whether you're legal or illegal, you still have to buy food and those sort of things. So some areas will feel it the most, but I don't think it would really translate through to the stock exchange. Another question here from Katrina. There is a new law in the US that hasn't been passed yet, still waiting for approval for us to be citizens of both US and Oz, but not tax resident of the USA anymore. I did see that Trump was talking about a big one of that in the lead up to that. That's been lobbied for a long period of time. Whether it sees the light of day, I hope Trump gives it a push and makes it happen. I mean, virtually what you talk about there is citizenship-based taxation rather than residency, and it's pretty much the most punitive tax from a person's point of view, where they can be paying tax. That's why you don't see many US citizens living in the Gulf region here, because there's no DTA or double taxation between the two, and it's just too expensive for a US citizen to live in, say, the Middle East, but pay tax back to Uncle Sam. So fingers crossed, Katrina, that works. Another question here: as an expat on tax-free salary, does it make more sense to bank in Australia or with a bank like HSBC Expat? I'll have a crack, and then I'm going to throw it over to Ben, because I've got a couple of curly ones for him. So to me, it depends on what you're doing with the money. If you're just parking it, go where the best return is, as long as that money's got an intent. Time and again, we see clients and expats in general sending money back to Australia, just building cash, and then sort of almost being surprised how quickly it builds, but there's no intent for that money sitting there. So I'll always say put it where A, it's safe in terms of regulatory and consumer protection, B, it's a good return for you, and C, liquid. You want to have, obviously, as liquidity benefits. HSBC Expat is a very good benefit. It's very simple, it's sort of simple. It's very simple, but very flexible when it comes to managing money, but you do pay a price for that. Their interest rates they charge on their cash accounts are quite low, and their fees that they charge on their accounts are quite high, especially if you're doing FX conversions. So just crunch the numbers. If it's a place to park money, then it's not bad. But Ben, here's a question for you. I've got to throw a Dorothy Dixie here. If a client had an accumulated bank account balance in Australia, let's call it $500,000, and other issues start to build to show ties growing in Australia, can the ATO use that cash sitting there doing nothing as, can they weaponise it against them in terms of claiming residency?
It has been in the past. It's part of the overall discussion. There was a case a couple of years ago called Snedden, where they found that the individual was effectively stockpiling as much cash as he could in Australia and living in the Middle East, but not really putting down roots in the Middle East. And it became part of their argument to say that, yes, they were still a resident because of the fact that they hadn't built ties in that other country and were really kind of still tethered to Australia and looking to feather the Australian nest. So my view on that is it's kind of, if you're living a normal lifestyle in whichever country you're in, that's not hindered by where you're putting your cash, then I don't think it matters too much. But if you are saving every penny and not really living a life, and it's really just your intent is to be overseas so you can earn enough money to build a better life in Australia in the short term, then I think Australia might have a problem with that.
Okay, fantastic, mate. I thought so, but always good to hear from the horse's mouth. Just about to keep rolling through some more questions. For folks out there who do like podcasts, we do have 3. So we've got Expat Chat, which is James Ridley and myself talking about general finance matters for Australian expats. And we get everyone on that thing. It's quite a lot of fun. Then we also have the Expat Mortgages podcast. That's Jeremy, who's on the call with James as well. So that's talking about all things property, mortgages, financing. And then the last one, we had the weekly Atlas weekly recap, which is run by Martin, our colleague out of the Australian office, and he's doing a great little synopsis of or summary of what the week that's been and what's coming up ahead. So make sure you guys look out for that. Here's a question for you, Mr. Turner. Hey guys, from Tony, living in Norway and about to receive a lump sum of money from a family will to my Australian bank account. Are there any tax implications on this money, and can I send it to Norway?
So there's a number of issues with wills and receiving money as non-resident, but if it's just cash you're getting, then no real tax implications in Australia for receiving that money whilst you're a non-resident. The situation is different if it's property or if it's shares. You need to really work through the detail of that, and sometimes the wills will have flexibility within them to be able to massage how you receive the funds so that it's not disadvantageous to yourself or other people within that will. So if it's just cash, then it shouldn't be a problem in Australia. But I always say in those circumstances, you need to look at it from a global perspective. And in your case, you need to see whether Norway would tax you on that, because if they tax you on it, then maybe there's a way that you don't bring the money into, say, Norway, or it's not realised at this point in time, or see what's flexible so that you don't then get stung on the other side.
Yeah, great answer, mate. Another question for you, Mr. Turner, from Leon. Question regarding individual tax returns, section 20. This will test your knowledge, or your memory, I should say. Foreign sourced income and foreign assets of property. And then he goes on to say, assets located outside of Australia, which had a total value of Australian $50,000 or more. What is the background of this section? I own a house in Germany and tick yes each year, but want to know the background of the section / question. Will there be future issues in Germany or Australia, or what should I be aware of? Thanks for the great webinar.
Yeah, good question. Look, it's an obscure flagged item in item 20 of the tax return, asking you if you've got more than 50,000 in total assets outside of Australia. The ATO has never given me an answer that I've felt has answered that in its entirety. I think it's just been there. I can't remember it ever not being in there. I've been doing this for close to 20 years, so that it's going back a while. But effectively, my answer would be you should answer truthfully. I think the ATO has several different touch points about where they can assess you and flag you for audits and things like that. If you mark that as no, but then you repatriated back to Australia and you sent $100,000 back, then to me that would raise an audit flag, because you're maybe not answering your questions truthfully. So I would say at this point it's probably just to anticipate, is this person going to repatriate funds back to Australia in the near future? Should we be expecting that? Outside of that, I've not seen it being a direct cause for an audit that I've seen. So the short answer is I'm not sure entirely. I don't have access to the inner workings of how the ATO use that data, but I would answer it truthfully.
Good summary, mate. Just tread carefully, and I always say to clients, the best place to hide is in plain sight. It's amazing what can bite you in the backside for something you did 5 years ago that you totally forgot about, and it's always good to be forthright. Another question for you, Ben. You're popular today, mate. I have a property in Sydney. I missed the previously given deadline for the MRE exemption in 2020, so couldn't sell it due to a higher CGT. and still within the 6-year time frame, ends in November 2025. What will be the best option for me to sell it or hold it? Would appreciate your response. Okay, good luck.
Yeah, look, it's a good question. We get a lot of these sorts of scenarios. The answer is always it depends on your scenario.
Yeah.
And what we do is modeling for a lot of people, and we do a sell now sort of scenario to say, all right, this is what your amount would be. And that's, it depends on the gain. So if the gain's not massive, then maybe that's worth paying a little bit of tax and having the funds available to you. But if the gain's significant, if you've held it for a long period of time prior to leaving Australia, for example, then we're dealing with some big numbers. Then normally the best outcome is to wait till you come back to Australia before you realise that, even if you go past the 6 years, because at that point the CGT is only proportional on the main residence exemption for those years exceeding 6 continuously. So there's a few other options there we can do as well when contributing to super. So normally I like to have a bit of a chat with people and figure out what they want to do, and everyone's circumstances is a bit different, but we do a lot of modelling on that sort of thing.
Yeah, I think that's a lot of people don't realise that moving back into the property, you can actually bookend the MRE and get a partial at least anyway. And if you've been holding it for 10 years and you get 6 of them for free, it's a pretty big discount.
Yeah, exactly. Plus the time that you lived in it before you left as well means that you might have a pretty small fraction subject to tax in Australia.
Yeah, that's spot on. Another one for you, Ben. Would purchasing a holiday property in Australia for occasional personal use potentially create a tax residency issue? Good question.
I would say more than other things, yes, it probably would. You need to come up with a story as to why you've got a holiday house that's available for your use in Australia. They'd look at that in conjunction with how frequently you're using it. Is it leased out on, say, a holiday rental platform on a sort of commercial basis more than not, those sorts of factors as well. But if it does indicate a pretty strong tie, if you've got a property that's available for use at all times and it is frequently used by you and family members, it does indicate tie, especially if you start putting furniture, putting cars in a boat that's perhaps registered there. It starts to tell a story of residency. So I'd be a bit cautious on that.
It certainly exposes you to the new... Oh, sorry, Jeremy. Yep, go.
I was going to ask you maybe a cheeky question to Ben off without notice, but if a client does have a holiday home, let's say they've got it through Stays or Airbnb full time, and that owner does want to occupy the property, would it be worthwhile, booking as a separate tenant on the, say, Airbnb platform? Maybe as under a cousin's name and actually pay through. So there's an audit trail that you're not actually staying in the property.
Look, I think there's merit to staying in the property on occasion yourself. I don't think that's necessarily something I'd avoid, but the more you do it, I wouldn't necessarily book through someone else necessarily, but you want to limit how much you do stay in that property. They will, like in the case of an audit, they'd ask you direct questions on how often you're using it, and then you need to be forthright with that. And if there is something that looks like it's trying to shield the real results, and they don't take kindly to that sort of thing.
Yeah.
I guess also too, Ben, it sort of exposes you into the new proposed residency rules too under the accommodation factor test, where a taxable Australian property is not permanently leased.
Yeah, definitely. Now, I don't want anyone to get too caught up on that. It was part of the proposal. It's definitely not law, but yeah, it definitely shows what some people are thinking in the sense that if you've got a property in Australia, then maybe it might be easier to become a resident.
No, spot on. Another question for you, Ben. What is the situation for a permanent resident living in Australia who spends less than 200 days a year in Australia, but more than 183? So a tax resident from the point of view of the ATO, and has a rental property in Australia. Or do the New South Wales OSR consider you liable for land tax surcharge? Bit of a mixed question there, I think.
Okay.
So
yeah. So let me sort of go through a few things there, because there's some assumptions there that are a bit of a misconception. So firstly, the 183-day rule is a two-part rule. The 183 days is the first component. The second component is whether you've got a usual place of abode outside of Australia. So if you're here more than 183 days, so say 200 in their case, but you have a usual place of abode outside of Australia, now that's open a little bit for interpretation. There's case law principles guiding that, but If you can show that you've got a stronger connection to another home outside of Australia, then it's likely that you still failed that 183-day test. So that's the first point. The second point is around the New South Wales OSR considering you liable for land tax surcharge. Now that is effectively only applicable, so if you're an Australian citizen, you're not considered a foreign person under any of the state-based rules. So bear that in mind. But each of them do have their own specific requirements. So if you're not an Australian citizen, as to whether or not you're considered a foreign person or not, and that's probably where the 200 days comes from, because that is, I believe, in one of those states, perhaps New South Wales, which is why you've raised that.
That's right. I'll just jump in on that. That 200 days is quite specific, as you said, to New South Wales state only, and they calculate on a couple of their foreign taxes. If you are a permanent resident of Australia and haven't been in the state of New South Wales for 200 days, then they will define you as a foreign person from a New South Wales point of view.
Gotcha. Good to know. Question for you, Ben. From George, is the 182-day, and I think it means 183, 182-day minimum stay in Oz still the benchmark as a domicile? But I think you answered it before. That's a two-part question, isn't it?
Yeah, it is. It is, exactly. So you've got to meet, you only have to meet one of the four tests to be resident. The domicile test is actually different to that. The domicile test looks at where you originated from, if you're a citizen of Australia, or if you've obtained PR in Australia and made Australia your home, then you revert back to Australian citizenship. Australian tax residency, unless you've got a permanent home outside of Australia. But the 183-day test is a two-part test, as I mentioned before.
Okay, fantastic. Another question from Anonymous. Will this recording be available? Certainly will. Everyone will be sent a copy of this in the next 24 hours. Another question from Anonymous. What about leasing my property to my parents, but on an official lease with money received? Follow up to a previous question.
I think that's better than just leaving it vacant, definitely. Although interestingly, I've seen someone who came to me and said that they presented that situation to the ATO and they said that they viewed that as still being available for their use. I don't really agree with that, and I think it does depend on the case officer you get at the tax office as to whether that's the case, and perhaps they could have appealed that decision and had someone else look at it. It's not something, in my view, if you lease it to a third party and they've got legal rights to occupy that property, it excludes other people, including the person who grants that lease. So that's the argument I'd be running with. So, but it is less strong, I think, than renting it to a completely independent third party.
Good answer, mate. And last question here. What are your views on using HSBC expat trading platforms as opposed to the Australian-based one? I guess there's two answers for this. First one is, coming back to my original point, a lot of banks are rebadging interactive brokers as their own service. So, you need to understand the domicile, whether it's HSBC, Saxo, Swissquote, any of those ones. There's a big migration towards US domiciled accounts. So that's the first one, which does, leave me in cold sweats. Second one is, the problem with a bank trading app is quite often they're incredibly expensive, which HSBC can, depending on what type of relationship you have or don't have with HSBC. And second of all, the cheap ones, then when they talk about no fees, quite often they're actually doing what we call a bid-ask spread, where instead of charging you brokerage or commission, you're actually getting a worse price for the actual ETF or whatever investment you're looking at. So that is not just for expat trading, but for everything else. People do use it. It's convenient. You can link it off your bank account. It's why CommSec is so popular back in Australia. But you just need to do your homework first, find out the costs, find out the domicile, and find out where those assets are held, because it could look good on the cover, but if something goes wrong, it could cost you a pretty penny. So I hope that gives you the answer there. Guys, I think we wrap it up there. We've gone through the questions. I think we give these people their day back and let you guys go off and have some dinner. It's late there in Sydney and Adelaide. So thank you once again. For folks out there, if you are interested in having a chat with any of us on the panel or the other amazing team we've got, hit us up at atlaswealth.com and we look forward to talking to everyone and meeting everyone on the next session. Take care.
Thanks, guys.